Gold doesn't have to replace a dollar.
We're at sub $60 silver right now.
Higher treasury yields are bad for gold because gold doesn't pay interest. And I think that the real erosion of purchasing power is much, much higher than the government reports. Sovereign buyers, governments are accumulating hard assets. Silver is both a monetary metal, but a critical industrial metal. Could the T-bill rates pressure gold in the short term? They already are. Even the anticipation of perhaps higher rates are. But the paper market always seems to react to these headlines. The long-term trend is not driven by that. It's driven by the treasury market that has been weaponized, the fiscal irresponsibility of this country and the monetary stupidity that we've exhibited for a long time. So gold isn't really competing with treasury bills. It's competing with the long-term loss of fiat purchasing power. You got record central bank buying, you got record repatriation. All these countries bringing back their gold from the New York Fed and the Bank of England. India, France, Germany, Holland, Austria, Turkey, Poland, they all brought their gold back. They want physical possession.
We're at sub $60 silver right now, and yet we're in the 6th consecutive year of a silver supply deficit, according to the Silver Institute, with very little mine supply rising to meet that deficit. $60 silver, actually pretty good price, all things considered. But stackers are obviously getting concerned. I see a lot of comments on this channel that we might not make it back to triple digits. What would you say to those who want to throw in the towel on silver? Maybe those who bought in the run up to 120 and are now potentially regretting their decision.
Maybe they're focusing on the wrong thing. I mean, let's start with the Silver Institute data. They say we're in the 6th straight year of a structural deficit. And then I would ask the simple question, how long can demand exceed supply before price finally reflects it? It is frustrating, Jess. It is, brother. If anyone gets it, it's me. But silver is one of the few commodities where the paper market sets the short-term price. And futures traders move the price today. It sucks. Physical availability determines it over time. At the same time, where things are beginning to change is the world is building new precious metals markets in Hong Kong, in Singapore, in Dubai. And that's important because the center of price discovery, which has been the epicenter, has been the CME and the LME forever. It's gradually shifting towards markets that value physical delivery, not just paper contracts. That's a big one, and this is happening right now.
6 straight years of supply deficits should not coincide with deeply discounted silver prices, yet that's exactly where investors find themselves today. Andy Schectman notes the real shift is occurring as new physical trading hubs emerge beyond Western paper exchanges, quietly challenging decades of price control. Markets can ignore tightening supply, but they cannot manufacture physical metal forever. Investors chasing headlines risk missing the structural transition already underway. Next, Andy Schectman reveals why physical price discovery threatens the paper pricing system itself.
So, sovereign buyers, governments are accumulating hard assets, and silver is both a monetary metal, but a critical industrial metal. And that's a powerful combo in my mind. So yeah, it can stay frustrating longer than people would expect. The market can stay irrational, they say, longer than people can stay solvent. That's all true. But, I guess markets exist to wear people out before they pay them. And if your conviction was based on structural supply deficits, shrinking inventories, and the shift right now towards physical price discovery across the globe, this is a big one. I'd argue the thesis is stronger today than it's ever been. I think a lot of times people make the mistake confusing price with value. Price is what the paper market says today. Value is determined by fundamentals, and eventually fundamentals will win, and I think they will this time too.
You mentioned central bank gold buying. We have now seen gold officially surpass U.S. Treasuries as the largest reserve asset. This was at the end of last year. This was originally reported. As you mentioned, they're continuing to buy at a record rate. Do you think they see something coming up ahead in terms of a monetary reset or gold being reintroduced to the monetary system in some way or another? Is it more innocent than that, in that they're just simply continuing to protect their wealth from counterparty risk in the aftermath, of course, of the U.S. and their allies seizing Russia's FX reserves? What's your take on the reasons behind this accumulation, and if perhaps they see something ahead that the general public isn't aware of?
Central banks rarely accumulate record amounts of anything without expecting the financial landscape to change. According to Andy Schectman, sovereign buyers are treating precious metals as strategic reserves, while most investors remain fixated on daily price swings. That disconnect suggests institutions are preparing for risks far beyond inflation headlines alone. Waiting for official confirmation usually means paying much higher prices later. Next, Andy Schectman exposes what relentless central bank buying implies about the future monetary order.
I mean exactly what they're preparing for, I'm not sure. Anyone who says they know, I guess you could say, is speculating, but I think we can observe what they're doing, what the footprints are saying. And to your point, central banks have purchased over 1,000 tons of gold a year for, I think, 3 or 4 consecutive years. And these are the most, let's say, informed financial institutions in the world, and well, they have access to information just that, and analysts, I suppose, that most of us will never see. And when they all began moving in the same direction several years ago, it caught my attention, and doing so quietly and yet consistently. And the most important part is regardless of price, they're price inelastic in their accumulation. They don't care. And that's why I'm paying attention, because look, Poland is a good example, right? They bought more gold than just about anyone for the last couple of years. And the head of the Polish National Bank recently came out and said their target is 700 tons. But I wrote something down because I wanted to read it to you. He also said something, what are they preparing for? I'm not saying this is what they're preparing for, but to hear something like this coming from the head of the Polish National Bank, who's bought more gold than anyone the last few years, I found to be very interesting. His name is Adam Glapinski. And they asked him, he clearly, why are you buying gold? And he said, well, we've been consistently buying gold, taking advantage of these recent price drops. He said recently at a press conference. That isn't what got my attention.
The timing of institutional buying matters far more than the headlines explaining it afterward. What Andy Schectman is highlighting is that central banks have accumulated over 1,000 tons annually, regardless of rising prices or temporary pullbacks. That behavior reflects long-term strategic planning rather than short-term speculation. Retail investors often wait for certainty, while institutions position before certainty ever arrives. Next, Andy Schectman unravels the remarkable statement from Poland's central bank that few investors have noticed.
I found that to be interesting, that as the price was dropping, the paper price, Poland is accumulating it, tells you where they think it's going. But what he said is something I've never heard a central banker say. I'm going to read this to you. He says, in these difficult times of global turmoil, there are 2 points I want to highlight here, okay? In these difficult times of global turmoil and the search for, here's number 1, a new financial order. So he's saying tumultuous times and the search for a new financial order. Gold is the only safe investment for state reserves, and gold will retain its value, number 2, even when someone cuts off the power to the global financial system, destroying traditional assets based on electronic accounting records. Let me read that one more time. In these difficult times of global turmoil and the search for a new financial order, gold is the only safe investment for state reserves, and gold will retain its value even when someone cuts off the power to the global financial system, destroying traditional assets based on electronic accounting records. Of course, we don't assume this will happen, but as the saying goes, forewarned is forearmed, and the Central Bank of Poland is required to be prepared for even the most unfavorable conditions. I mean, I don't know, Jess, it seems to me that footprints are unmistakable. You got record central bank buying, you got record repatriation, all these countries bringing back their gold from the New York Fed and the Bank of England, India, France, Germany, Holland, Austria, Turkey, Poland, they all brought their gold back. They want physical possession and removal of counterparty risk.
Governments publicly praise financial stability while quietly preparing for scenarios where the system itself could fail. Andy Schectman's argument suggests Poland's comments reveal concerns extending far beyond routine reserve management. Repatriating gold while warning about a new financial order exposes a contradiction mainstream analysis rarely addresses. Wealth preservation begins by watching official actions instead of official reassurances. Next, Andy Schectman reveals why global gold repatriation is accelerating behind the scenes.
You got new physical exchanges, alternative payment systems, BRICS, the BRICS bridge, and the Chinese SIPS, cross-interbank payment system, settling imbalances in gold, and a steady migration of gold from west to east. It's been the largest export of the United States for like the last 6 months. And to me, those aren't isolated events. These are pieces of the same puzzle. I don't think we've even seen the finished picture yet. So I guess, could it culminate in some type of reset? Maybe. Could it simply be preparation for this new multipolar world we hear about? Monetary system where gold plays a larger role? Maybe. But I don't know. I think I would leave it with this and say gold doesn't have to replace the dollar to become dramatically more important. And it just has to be reintroduced as a new, or not new, a trusted reserve asset, which it is, and a settlement asset, which it is, or collateral between nations, which it is. So I guess we're already starting to see signs of that. And I don't know. I guess I would say that by the time governments tell you what's really happening, the people closest to the system have already positioned themselves. And look at what the central banks have been doing, and you can see that is what they've been doing, positioning before it is in vogue, I guess you could say.
Interesting to note as well, the government here in Serbia recently repatriated their gold from Switzerland. Definitely does seem to be a global trend, as you pointed out. I want to talk about what could be a sovereign debt crisis.
Your greatest financial risk may be assuming tomorrow's monetary system will resemble today's. This is where Andy Schectman's thesis shifts from price forecasting towards structural change, as gold increasingly returns to settlement and collateral roles between nations. Institutional positioning often begins years before the public recognizes the trend. Preserving wealth means following capital flows instead of comforting narratives. Next, Andy Schectman exposes why sovereign debt could accelerate this global transition.
But what could also be a headwind on precious metals prices, and that is rising T-bill rates. Do you think they're putting pressure on the price of gold and silver? We're seeing yields rise kind of across the sovereign debt world, along with the potential for inflation ahead due to the rising cost of energy. Some believe that's going to force the Fed to at least not cut rates and potentially even raise rates at some point. And at that point, of course, if you can get a decent return on treasuries, the thought is gold becomes less attractive as it doesn't have a yield. What are your thoughts overall on the sovereign debt market, its impact on precious metals? And maybe if you could talk about the potential for a crisis there as well, because a lot of people are talking about that.
I don't know. To me, it kind of misses the bigger picture because, again, this traditional argument is that higher treasury yields are bad for gold because gold doesn't pay interest. I guess that's fair enough, I would say, but what really matters to me isn't the nominal yield, it's the real return after inflation. And if you believe inflation is 2% or they have any reasonable shot of obtaining 2%, then a 5% T-bill looks great. See, but I don't. And I think that the real erosion of purchasing power is much, much higher than the government reports. So the safe yield may not be preserving your wealth at all. In fact, you're going backwards in real terms. And this is the dilemma. I mean, if energy prices keep rising, which we said earlier, they may, then inflation stays sticky.
Higher treasury yields appear attractive until inflation quietly consumes most of the return. Andy Schectman notes nominal yields mean little if purchasing power keeps eroding beneath the surface. Markets celebrate interest rates while overlooking the compounding damage from persistent inflation and expanding debt burdens. Savers focused only on percentages may discover they're losing wealth in real terms. Next, Andy Schectman reveals why the debt market leaves policymakers with no painless option.
And the Fed, can they keep rates high? I mean, if they do, that means paying even more interest on the 40 plus trillion in debt or they can cut rates and risk even more inflation. Neither is a great option. And I think, this is why I personally pay more attention to what the central banks are doing, because the central banks aren't buying record amounts of gold because they're worried about next month's rate decision. They're buying it because they understand the long-term consequences of too much global debt and debasement of the dollar. Look, could the T-bill rates pressure gold in the short term? They already are. Even the anticipation of perhaps higher rates are. But the paper market always seems to react to these headlines. The long-term trend is not driven by that. It's driven by purchasing power or eroding purchasing power of the dollar, the massive amount of debt we have, and more than anything, the confidence, not only in the currency, but like you said, in the treasury market that has been weaponized, the fiscal irresponsibility of this country and the monetary stupidity that we've exhibited for a long time. So in my mind, gold isn't really competing with treasury bills. It's competing with the long-term loss of fiat purchasing power. If you understand that, then the record buying by central banks makes perfect sense, because they understand. They're accumulating the one thing they can't print, because they understand that ultimately the erosion, as Dr. Franz Pick said, the first book I ever read in this industry, all currencies, fiat, are inherently meant to die.
The Federal Reserve's policy choices are narrowing as debt servicing costs continue climbing relentlessly. According to Andy Schectman, central banks are buying gold because they recognize long-term currency debasement, not because of quarterly interest rate forecasts. That institutional behavior directly contradicts the narrative that higher rates permanently weaken precious metals. Investors ignoring this divergence risk protecting income while sacrificing purchasing power. Next, Andy Schectman exposes the hidden competition between fiat currency and tangible wealth.
So saving in dollars is like holding a melting ice cube. You transact in them, but you save in assets. And the same thing would be true for treasuries. The higher the yield, you'll get to a point with rising yields where the whole system breaks. Can't do that. And so they're caught. And I think understanding this, the central banks do, using price to misdirect for the central banks to accumulate, well, it seems like a fairly stable, sensible strategy. And I think that is what they're doing. Most of the world is using the Western suppression against them. They're the ones that are accumulating. This is the flow heading that way. This is the arbitrage we've seen with silver for over a year, where you're getting this 10, 11, 12% kicker by delivering to China. Won't end. I think they understand this, and I think that you will see a continued accumulation of gold by the central banks, not to become wealthy, but because it is wealth, and the paper currency that we call money is literally evaporating in terms of purchasing power right out from underneath us. So I think you have to have a long-term outlook on this and not be distracted by the short-term noise, because when you see the amount that the central banks are buying as the price is getting, carjacked, it should tell you what it really is. It's misdirection. Now they talk about the expansion of the Shanghai Metals Exchange. You're seeing it already. The first one was built in Hong Kong. That's really important. Set aside the price setting, but when gold is delivered, it has to come out of Hong Kong.
Markets often fall just as the strongest long-term buyers quietly increase their accumulation. What Andy Schectman is highlighting is that central banks exploit price weakness while retail investors mistake it for deteriorating fundamentals. The difference between institutional patience and emotional selling has defined many major market cycles. Long-term wealth usually follows disciplined positioning rather than daily price action. Next, Andy Schectman unravels why Asia's expanding gold infrastructure changes global pricing dynamics.
And they want to expand. They've already, rumors are, or news is, and it's very quiet, that the one in Saudi Arabia is operational. It will connect with the one in Dubai. They want to build one in Switzerland and in London. They want to build them all throughout the Belt Road Initiative to settle imbalances in gold. Instead of accumulating treasuries, they'll accumulate gold and trade with one another cross payment systems. Now, this is being sold as internationalization of the yuan, but make no mistake, it is the rails of the BRICS. And I think they're doing it to specifically not to antagonize this administration. But, you know, it is very much the exact same thing. And that is a path that is a slow-moving path, but chips away at settlement in dollar, chips away at the reserve status as less money is being recycled into treasuries. That inflation that we've sprayed, as Luke Groman says, all around the world by countries taking our treasuries, wanting our treasuries, accepting our inflation, as now, he says, like taking that fire hose and bending it into the basement window of our own house, and you'll see much higher price inflation simply because no one wants our treasuries. So who's going to buy them? Does it mean the Federal Reserve has to buy them? Monetization, create, you know, money to buy them. This is a situation where, to me, it's about not de-dollarization as much as it is de-treasurization, if that were a word. And is, you know, the dollar's not going anywhere tomorrow. They will continue to settle and trade in dollars, or to trade in dollars and to, you know, settle dollar-based debt in it.
The biggest shift may not be away from the dollar, but away from US treasuries themselves. Andy Schectman's argument suggests new settlement networks are gradually reducing dependence on American debt without requiring an abrupt financial revolution. That evolution receives little attention because it unfolds over years instead of days. Investors focused only on headlines often miss structural changes already reshaping capital flows. Next, Andy Schectman reveals why Treasury demand could become the real pressure point.
But make no mistake, I believe they will be accumulating commodities like gold instead of U.S. Treasuries. China is a perfect example. It's over halved its Treasury holdings, and they're buying gold instead. So it's just a gradual shift. And I think people who analyze the BRICS have a hard time accepting the way that they do things, methodically and plotted. And over time, there is no instant gratification. But make no mistake, you can see the rails are being built, and they are significant in terms of what they would absolutely mean if they really became mature. So yeah, I think it's still something we'll continue to hear much more about.
The market rarely announces structural change until the opportunity has largely passed. This is where Andy Schectman's thesis shifts from daily price forecast toward the slow replacement of treasury accumulation with hard assets. Patient institutional positioning often appears boring before it becomes obvious in hindsight. Investors who understand gradual transitions gain advantages unavailable to those chasing immediate confirmation.